In this video, I want to share with you the fundamental principles, how to interpret and use market information that can help build a solid foundation for growth and profit in trading. I've packaged everything into a compact strategy called Combo Algorithm 2.0, which includes both swing and intraday trading. It's important to note that the presented material is somewhat patternized for easy application and understanding, but the main thing is to grasp the logic, which is indispensable. Let's start with this formula that embodies the basic principles of trading and consists of 4 key stages: analysis, idea, validation, invalidation, decision. Analysis is the first and most crucial stage in a trader's activities. It involves a comprehensive process of collecting, processing, and interpreting information that will form the basis for making trading decisions. For example, this could include checking the economic calendar, company reports, indicators, and other data. However, within the scope of this video and trading strategy, we are interested in top-down analysis. Abbreviated as TDA, this is a method where macroeconomic factors and the overall market picture are studied first, and then the focus shifts to more specific aspects. In other words, it's a sequential analysis of charts starting from the higher time frame and ending with the lower one. Here we won't invent anything new and will use a pre-prepared template of time intervals, starting from long-term and ending with short-term ones. 1 month, 1 week, 1 day, 4 hours, 1 hour, 15 minutes, 5 minutes, and in some cases even 1 minute. The choice of these specific timeframes is determined by several important factors. First, these time intervals are the most common and accessible to virtually all traders, regardless of their trading platform or broker. This universality significantly affects their effectiveness, as a large number of market participants analyze the same timeframes, creating a sort of self-fulfilling prophecy. Secondly, this set of timeframes provides an optimal balance between detail and overview. Monthly and weekly charts give a general understanding of long-term trends, while daily and 4-hour charts allow you to see the medium-term picture. Hourly, 15-minute and 5-minute intervals are ideal for intraday trading. Returning to our top-down analysis, schematically this can be represented as a distinctive staircase, where each step symbolizes a specific time frame. Starting from the topmost step, we gradually descend, revealing more nuances and details that help us better understand the market context. This process can be compared to increasing the detail on a map. The lower we descend, the more details become visible to our view. In fact, this analytical approach is based on one fundamental principle which states, the higher the time frame, the greater its significance and impact on the market, as it reflects more global trends and long-term changes in price behavior. Consequently, their formation requires more time, which makes them more reliable, because they are less susceptible to short-term news and market noise. But here a question may arise: what is the purpose of this action? The answer is actually simple. It's the formation of ideas which constitutes the second stage. In simplified terms, an idea represents a well-founded assumption or belief about the likely future behavior of price, based on identified and synchronized market variables. We'll discuss the variables a bit later. Now let's look at a specific example of an idea to better understand this process. Let's say that during our analysis, we discovered an important zone on the chart that interests us and, in our opinion, could reverse the price in the opposite direction after being tested. In other words, we have an idea that this zone may provide a reaction that we can monetize. After forming an idea, the next stage is validation or invalidation, which constitutes the third step. For this, we need to wait for the selected zone to be tested and then receive a confirming signal that the price is ready to move in the opposite direction. This will indicate the validity of our idea and confirm that we were right. It's important to note that signals can vary and depend on trading strategies. We won't focus on that now. However, if during testing, the price doesn't form a confirming signal or completely ignores and breaks through our zone, the idea is considered invalidated, meaning our assumption was incorrect. Depending on the obtained result, a further decision is made about entering a position, skipping the trade, and so on. This decision is made according to the trading algorithm or strategy, which we will also discuss later. This process constitutes the fourth stage. However, despite the fact that the described formula is a fairly reasonable and conservative decision-making method, there is another approach: making decisions without validating or invalidating ideas. This can be called instant decision. The essence is as follows. When we discover a significant zone, we immediately take on the risk, acknowledging the probability that the price may or may not give a reaction that we can monetize. Ultimately, an instantaneous decision is made to enter a position directly from this zone or from certain levels within it. I hope the logic is completely clear, and we can move on to examining the variables used. In their basic interpretation, there are only 4 of them. First, there's the order block. To reduce its definition to the simplest formulation, a bullish order block is a price movement where a resistance level is broken with subsequent confirmation by the candle body closing above it. A bearish order block is a price movement where a support level is broken with subsequent confirmation by the candle body closing below it. That's it. Nothing else is needed to identify an order block. Here are several real examples. Second, there's the rejection block. It always consists of 2 candles, where the range of shadows of both candles forms a zone of interest, and it doesn't matter at all which one is longer or shorter. In the bullish variant, its beginning is a support level, consisting of sell plus buy candles. In the bearish variant, its beginning is a resistance level, consisting of buy plus sell candles. Third, there's the fair value gap. It consists of 3 candles, where the shadows of the first and third candles do not overlap each other in both bullish and bearish variants. Here are examples from real charts. And the fourth final variable is the fractal point. Here it's important to understand that this is specifically a price level, not a price zone like the previous variables. It turns out that a fractal low is a formation of 3 candles, where the minimum of the middle candle is lower than the minimums of the first and third candles. Similarly, when the middle candle has the highest maximum compared to the adjacent candles, this is a fractal high. In both cases, we need at least 3 candles that will indicate price extremes. While this may seem like very simple logic, but there are still people who don't understand why we use 3 candle patterns instead of 5 candle ones. Yes, 5 candle formations are considered more stable or reliable, but essentially these are the same extreme points that could be formed from even 10 candles. There's no difference. Another important aspect is understanding what functions of variables exist. I'll say right away that there are also only 4 of them, and some of these names were invented to simplify understanding of the concept, and you can call them whatever you like. The zone of interest function represents a specific region on the chart with the potential to change the direction of price movement. In professional terminology, such a zone is also known as a point of interest. The basic interpretation of the zone of interest includes all previously mentioned variables: order block, rejection block, fair value gap, and fractal points. However, it's important to note that the concept is not limited to just these elements. It can also include other variables such as inversion fair value gap, balanced price range, mitigation block, breaker block, redelivered rebalanced, hidden block, and others. In other words, you can use anything if you're confident in the functionality of a particular element. The trouble area function is implemented by all 4 variables, but the key ones are fair value gap and fractal points. They are not chosen randomly, as they possess a unique ability to provide the greatest amount of liquidity to the market compared to other variables. In essence, it's the same zone of interest, but with one significant difference. It is oriented against us or our positions. It's important to note that the trouble area is always on the same time frame as the zone of interest. The volume confirmation function is exactly that confirming signal we talked about earlier, and which we use in our strategy. You could say it's analogous to the classic break of structure. It's performed by only 3 variables: order block, rejection block, and fair value gap, which usually form on a lower time frame after testing some zone of interest or in the context of news. Volume confirmation indicates that at a specific moment in time, and at a specific price, a volume of buying or selling entered the market. In other words, it's visual confirmation that buyers or sellers are dominant. We'll touch on this topic several more times. And the final function is liquidity injection, which acts as a catalyst for accelerating price reversal within the zone of interest and beyond. It is performed only by fair value gap and fractal points. You already know why. But before we move forward, we need to understand something. To compare variables or indicate their position relative to each other, we use 3 symbols. Greater than indicates that variable number 1 is 1 time frame higher than variable number 2. Equal to shows that the first and second variables are on the same time frame. Greater than or equal to indicates that variable number 1 can be either one time frame higher or on the same time frame as variable number 2. Accordingly, the zone of interest and trouble area are always located on equivalent timeframes, which is denoted by the equal to symbol. This fundamental rule has deep meaning in the context of market analysis, as we view these two zones as equal in strength and potential influence on price movement. And an important point, if the price has tested the zone of interest and confirmed volume on a lower time frame, meaning there is a greater than symbol between them. In such a situation, we can assume that with increased probability, the price will tend to reach the corresponding trouble area on the same time frame as the original zone of interest. This is the simplest logic by which price direction is largely determined within the day, within the week, and so on. At this point, we have discussed almost everything to more confidently move on to analysing the algorithm itself and how to open positions according to it. But I want to make a small digression. I think many of us have played computer racing games at some point. Let's imagine that we're also in a game where we're given a car in basic configuration with a 200 horsepower engine, and we need to win the race. Let's assume the probability of this event is 30%, and roughly speaking, out of 10 attempts, we will win only 3 on average. However, thanks to the game's upgrade system, we can modify the car's design or parts. Let's say we change the engine to a more powerful one, change the wheels and suspension, and improve aerodynamic elements. As a result, across different metrics, we get a probability twice as high, which is now 60%. And now out of every 10 races, we get 6 wins. But why am I telling you all this? Simply because we can apply the exact same upgrade system to our variables to improve their probability of working out. First, the simplest and most effective improvement for order block, rejection block, and fair value gap variables is to pay attention that they form in the context of a fair value gap rebalance or liquidity raid from older lows or highs. I emphasize, these zones attract the highest trading volume, showing strong market participant interest. And with increased probability when returning to these zones, the price will again receive a reaction and reverse or slow down. But if you want to protect yourself even more, I recommend using only variables that have made a liquidity raid. The reason is simple. When price makes a liquidity raid, there's no point in returning there again. However, when price rebalances an FVG, there is still a possibility that it may return, especially if the FVG is wide enough. Secondly, another important factor is added to all of this, the formation of a fractal point together with the variable. This will confirm the movement's extreme and serve as a reliable invalidation level, meaning the cancellation of ideas. In our strategy, this is called high-resistance fractal point, and since the variable itself is closely related to this, it will also conditionally be considered high resistance. However, there is one minor detail that might escape our attention. While the formation of a fractal point is guaranteed when creating a fair value gap, things are a bit more complicated for order block and rejection block. The issue is that sometimes the last candle creates the extreme of these variables, which is consequently insufficient for obtaining a fractal point, and therefore it may be necessary to wait for another candle to close. This isn't critical, and we can discuss the potential formation of a high-resistance fractal point because the main thing is the fact of obtaining the variable itself, which is already an excellent indicator of strength. As a result, we have variable number 1 in the form of FVG, or older fractal points, which is essentially a zone of interest. Then the price tests them and confirms volume in the form of order block, rejection block, fair value gap, which is already variable number 2. Plus, a fractal point is added. The question arises, how should we perceive all this? As a whole or separately? This may sound confusing, but the answer lies in the game of priorities that affect the difference between timeframes. In previous videos, I've already mentioned our interest in obtaining volume confirmation specifically on a lower time frame to optimize waiting time, despite the fact that this can be done on the same time frame. I gave an example that if the initial zone is on the 4-hour chart, then even the simplest 2-candle instrument, namely the rejection block, would take 8 hours to wait instead of 2 if we were looking at the hourly chart. In the end, it's worth remembering the following. When price makes a liquidity raid or rebalances a fair value gap, then confirms volume on the same time frame, and potentially forms a fractal point, this is primarily classified as a single high-resistance element. while maintaining the logic of volume confirmation. Conversely, when price makes a liquidity raid or rebalances a fair value gap, then confirms volume on a lower time frame and potentially forms a fractal point, this is interpreted predominantly as volume confirmation and is considered as two autonomous variables, while maintaining the characteristics of a high resistance element. Everything depends on how the information will be interpreted. Next, we will examine aspects that are unique to each of the variables. Let's start with the order block. First, an important indicator of this element's strength will be its impulsive nature of formation. From this follows that the order block should have an FVG inside, preferably one time frame lower. Later, you will understand why this is necessary. Second, it's the formation of a support or resistance level before a raid or rebalance is executed. I'll explain what this means. Sometimes price comes and tests an FVG or fractal zone, after which it receives a small reaction and forms a resistance level, for example. But shortly after that, it makes a re-raid, and only then do we see the order block zone. This clearly isn't the sign of strength in the tested zone, so we need to pay special attention to this detail to achieve maximum win rate, despite the fact that this mostly applies to fractal points. Next up is the rejection block. Since this element consists of two candles that form a support level in a bullish scenario and a resistance level in a bearish one, a good indicator of strength will be their formation outside the tested zone. As shown in these examples, this will indicate volume entering the market. Second, the longer the shadows of the two candles, the better, and consequently, the rejection block zone will be wider, giving the price room to react. And third, you can pay attention to ensure that the body of the second candle engulfs the body of the first. Finally, the fair value gap. This is an element that can be present almost anywhere on the chart. It is not as pronounced an indicator of reversal points as the order block and rejection block. Nevertheless, we prefer this element to form beyond the tested level of liquidity or inefficiency, which will indicate its true strength. Secondly, we know for certain that FVG is the most reliable indicator of momentum, that is, the balance between buyers and sellers in the market. Accordingly, the wider the FVG zone, the stronger the dominance of one side was. I'll repeat, these characteristics are designed to achieve maximum effectiveness and probability in our favor, but they are not mandatory. You can use variables that don't meet these requirements. I hope I haven't tired you with my long explanation and was able to explain everything I wanted to. Now let's dive into the trading algorithm itself. As you can see, it is divided into two parts: higher time frame, which let's say is mandatory for opening any position, and lower time frame, which is a supplement or optional part. In total, there are 17 entry points that we can use depending on market context. Despite the fact that the variables in the lower part cannot connect with each other. The first basic combination that embodies the logic of idea validation and from where an entry can be made is variable 1, volume confirmation, greater than variable 2, volume confirmation. Because order block is the most complex element of all, we'll start with it as our zone of interest or variable number 1. For example, on the 4-hour time frame in a bullish scenario, it has all the previously described characteristics, such as FVG rebalance or liquidity raid on the same time frame, the presence of a fractal low, as well as an imbalance inside. In the middle is a display of how the FVG looks inside the order block on the hourly time frame. The second variable confirming volume will be a similar order block on the hourly chart. Special attention should be paid to ensure that the price does not cover the entire FVG zone with its body, as this would indicate its invalidation. If this happens, we won't be able to get another high resistance fractal low. The position entry is placed at its beginning, and the stop loss behind the movement extreme. We'll discuss where to place the take profit later. When the second variable is a rejection block, the logic remains the same. The entry order is placed at its beginning, and the stop loss behind the movement minimum. But you need to be extremely careful with this because it's very easy to take a loss. I'll show an example of such a position a bit later. In the case of a fair value gap, there is a peculiarity, its invalidation level. In such a scenario, it's the lower boundary if a candle breaks through it and closes with its body below. Therefore, the entry is placed at its beginning as usual, but the stop loss is not at the FVG invalidation level, but behind the movement extreme, which would invalidate the idea in principle. Simply put, The logic is that both the first and second variables are high resistance, which by all criteria should increase the probability in our favour. However, sometimes it happens that the zone of interest in the form of an order block doesn't have an FVG inside, or the price simply doesn't react to it and only forms the second variable afterwards. The logic remains exactly the same. It's still the same volume confirmation with the same position entry parameters, but without the high resistance fractal low, which makes the probability of success slightly lower. Sometimes it's the opposite. The first variable is not high resistance, but has an FVG inside. In this case, in my opinion, it will still have a slightly lower probability compared to the previous example, even if the second variable forms a high resistance fractal low. And the final variant is when neither the first variable nor the second one rebalanced the fair value gap, or made a liquidity raid. This doesn't mean that the logic of validating the zone of interest through volume confirmation isn't relevant here. It can work just like in all other cases. However, it's a matter of probability. Most likely, you won't achieve maximum effectiveness. There are two key points left to understand: where to place the take profit and what minimum risk to reward ratio should be for entering a position with this combination. Let's start with the logic itself. If variable number 1 in the form of a zone of interest is validated by variable number 2 in the form of volume confirmation, then there is a higher probability that the price will tend toward the opposite zone, or as we say, the trouble area on the equivalent time frame. Therefore, if the risk-reward exceeds the minimum mark of 1.5, you can enter the position. This is the GBP/USD pair. On the 4-hour time frame, we can observe that the price makes a sharp manipulation, taking out liquidity from two fractal lows, after which, with an equally sharp movement, an engulfing pattern emerges, indicating a surge in buying volume. Now, any way you look at it, this is an order block zone that has a high resistance fractal low at its base. If we look at what happened on the hourly chart inside, we can see a fair value gap zone. And I can say without doubt that this is an example of a perfect order block. The price makes a retracement, completely covers the FVG, but doesn't establish itself with its body above the lower boundary, after which another order block forms with an impulsive movement. This confirms the price's readiness to reverse and move in the opposite direction. Yes, there are actually two order blocks here, but pay attention to the conditions under which their resistance levels formed. Regarding the trouble area on the 4-hour chart, it will be the nearest bearish FVG, from where selling volume could potentially come in. However, targeting it specifically would be unwise because we need to pay attention to the context. Above are equal highs acting as a price magnet, so that's where we'll be targeting. The position entry is placed at the beginning of the first order block, stop loss behind the idea invalidation level, which is also high resistance, and accordingly, the take profit at the previously described location. This results in a risk-to-reward ratio of 1.7, which suits us well. The execution of such a position didn't take long to materialize. We observe a similar situation with a daily order block that was formed by an impulsive movement after rebalancing another FVG. Plus, there is another daily FVG. When the price returns on the 4-hour time frame to test these zones, we also see a liquidity raid of the fractal minimum and coverage of the 4-hour fair value gap. All variables indicate that in this situation, the price is highly likely to reverse. In fact, we get confirmation through two methods from where a position can be opened. To the nearest trouble area, we get a risk-to-reward ratio of 2.6. This is the New Zealand dollar on the daily time frame. We can see an order block that rebalanced the fair value gap and broke through the resistance level. The price trades slightly higher and then returns to test our zone of interest. On the 4-hour chart, we observe another FVG, but unfortunately, it was invalidated. However, this didn't prevent the price from confirming volume in the form of another order block, from where we will enter the position. We set the take profit on the daily time frame, and again, see the equal highs zone. This is a very interesting example because the next candle immediately tests our entry level, and the price movement towards the target begins. Note that not a single black candle was formed, and ultimately we achieved a risk-to-reward ratio of 5.0. If anyone didn't understand, this is an example where the first variable is high resistance and the second is not. In this example, the first variable in the form of an order block didn't rebalance or take out anything. There are actually two of them. When the price comes for testing on the 4-hour time frame, we observe an FVG rebalance inside, which served as a catalyst for forming volume confirmation in the form of another fair value gap. The position can look as follows. To the nearest trouble area, we get a risk-to-reward ratio of 2.6. But we can risk more, extend the position a bit further and get 3.2. Note that on the daily time frame, the bearish FVG was invalidated, so it wasn't taken into account. In this example, the second variable is high resistance, while the first one is not. And the final example, where neither the first nor the second variable is high resistance. On the daily time frame, we observe an order block that formed in the context of another order block. When the price comes to test it on the 4-hour time frame, all FVGs inside were invalidated, but volume confirmation still formed, from where a position could be entered towards the nearest trouble area. This is an extremely simple and clear logic that you must grasp. I'm showing these examples deliberately. They are clear and not overloaded with unnecessary details, so that even a beginning trader can recognize the main principle. Since the FVG inside the order block is essentially nothing more than a liquidity injection that helps form volume confirmation, we can use a fractal point instead and get the same result. In fact, we have a separate combination designed for this. Nevertheless, let's look at an example where there will also be a rejection block. This is the euro on the daily time frame. I have already marked the order block that took out local and older liquidity. We switch to the 4-hour chart and see that there is an FVG zone inside the order block. The price first makes a raid on the fractal minimum's liquidity, then receives buying volume and is delivered inside our order block, where it forms the second variable in the form of a rejection block. Pay special attention to the fractal that was also taken out. Its function, similar to FVG, is to provide liquidity to the market. The price couldn't establish itself with its body above this level, which suggests an incoming selling volume. The position can be opened from the rejection block with a risk-to-reward ratio of 2.5. The take profit was set at the nearest trouble area on the daily time frame. After testing, the price gets a reaction but doesn't reach the target. It returns, makes a liquidity raid inside our rejection block, then aggressively moves down. This is quite a common behavior pattern, but we'll discuss it later. Let's examine the scenarios that occur when the first variable is a rejection block. There are only two possibilities. In the first one, the rejection block either rebalances the FVG or performs a liquidity raid. Then the second variable tests it and confirms the volume. Regarding FVG, it appears very rarely inside, and even when it does occur, you shouldn't rely on it too heavily. However, we can use fractal points instead, which will serve as an excellent liquidity injection. In the second scenario, none of this happens. Consequently, neither variable will be high resistance. I don't think I need to explain why this option doesn't deserve attention. Also, based on market observations, a combination where a rejection block validates another rejection block has a low probability of success. Therefore, I would recommend not using it. This is the euro on the 4-hour time frame. I won't focus on the global context now, I just want to show an example with a rejection block. It formed after a raid of two older fractals, which allows us to consider it a zone of interest. When the price comes to test it on the hourly chart, we see that in this context, there is a liquidity raid of the fractal within the rejection block. After this, volume is confirmed in the form of two order blocks. Let's say the position would be opened from the first one, with a stop loss behind the high resistance fractal low. The price tests it, gets a small reaction, but before exploding and going far above, it makes another liquidity raid inside the order block itself. Here, the rejection block formed under similar circumstances, but on the daily time frame. When the price comes to test our zone of interest on the 4-hour chart, it immediately receives volume, forming another rejection block. If we had entered a position from it, we would have hit our stop loss. But since we know this is an ineffective formation, we wait. The price makes a raid, covers this small FVG, and 3 order block zones are formed by an impulsive movement. Any of them can serve as an entry point. Let's say we prefer the second one. A retracement occurs, the price gets a reaction but doesn't go far. It comes to test us again, and only on the third time, after a liquidity raid inside the order block, does the price shoot upward. In fact, as you can see, our stop loss is always placed behind the second variable. However, if the risk-to-reward ratio allows it, it would be better and safer to place the stop loss behind the first variable, which would invalidate the entire global idea we have. This applies to any variables, to any zones of interest. And finally, the last variable as a zone of interest is the fair value gap. Since I've already mentioned that this element can form anywhere on the chart, it's not particularly important whether there was a liquidity raid or FVG rebalance before it. Of course, this would be a good additional factor, and it's worth paying attention to. But the most important thing is how the price forms the second variable. The best indicator will be a test and quick exit with volume confirmation forming outside the FVG zone, which will indicate true strength. Fractals can also be used as an additional factor. This is a 4-hour bearish fair value gap that formed right before equal lows. When we switch to the hourly chart, we see a fractal high that serves as the lower boundary of this element. The price makes a liquidity raid, simultaneously tests the FVG, and volume is confirmed in the form of another FVG outside the zone of interest, indicating incoming selling volume. As you can see, the position quickly reaches its target. Here, the FVG formed together with an order block after a liquidity raid. On the lower time frame, as in the previous example, volume confirmation formed after the raid and rebalance, which allows us to enter a position up to the nearest trouble area. If we mark this rejection block and then move to an even lower time frame, we'll again notice a fractal inside, after the raid of which the price received an impulsive reaction. Take note of this. And in the final example, the fair value gap was confirmed on the lower time frame with a rejection block from where the position was opened. I want to emphasize that you should only use those rejection blocks that, along with rebalancing, made a fractal liquidity raid. And after that, the second candle that forms them engulfed the first one. That is, as you can see here, a long green candle, indicating an impulsive reaction. I anticipate a question that might sound like this. Why, if the first variable is a zone of interest, do we mark it as VC in the algorithm? The point is that order block, rejection block, or fair value gap, already formed on the chart, automatically function as zones of interest. But, since these same variables also perform the function of volume confirmation, they effectively show that buying or selling volume has entered the market. Therefore, we can simply mark them as VC in the conservative interpretation. However, if the strategy uses more elements, including those that don't confirm volume in the market, for example, IFVG, then the first variable can only be designated as zone of interest. Again, it's a game of priorities. If our first variable is primarily a zone of interest and then volume confirmation, then the second variable is primarily volume confirmation, and then a zone of interest from which we make further decisions. The next combination, which also forms the foundation of the entire strategy, is variable 1 fractal point greater than variable 2 volume confirmation. First, what we need is, of course, a fractal point, meaning a maximum or minimum, that will serve as a zone of interest. We don't yet know if the price will confirm volume 1 timeframe lower after the liquidity raid outside this fractal, which would indicate readiness for a direction change. However, if this does happen, the second variable will have its primary function as volume confirmation, and only then as a zone of interest, from which further decisions about entering or ignoring a position are made. In total, there are only 3 possible variants of how this can look. In the first case, it's an order block zone. Note that the resistance or support level should not form after the raid. The second is a rejection block, where ideally the candle bodies should not close above the fractal point level. And the third is a fair value gap, which ideally should not touch the fractal level at all, which would demonstrate the strength of the incoming market volume. Based on personal experience, this combination has an even higher probability of success than the previous one. This is because all these variables are the result of price reaction to the liquidity zone, which always forms a high-resistance fractal point. The targeting logic remains unchanged. Let's look at real examples to get maximum benefit from this information. This is a daily fractal high that formed after a raid of a similar older fractal. Since the price immediately entered the trouble area in the form of a bullish FVG and order block, it received a reaction at the opening of the new week and was delivered upward to perform a liquidity raid. On the 4-hour chart, volume confirmation came in the form of an order block. Despite the candles closing outside the fractal, this is a matter of timing, we could enter a position up to this minimum. After the test, there was a quick, aggressive delivery. If I'm not mistaken, there were also news events here that acted as accelerators. Here, we have a weekly fractal low. On the daily time frame, a liquidity raid occurs and a rejection block forms. Logically, we can open a position from it and target the opposite maximum. The price tests the level and delivery occurs, slow but steady. However, this isn't the best way to use it. I'll show another method of entering from a rejection block when it serves as volume confirmation after a raid. As in the previous example, there's a fractal minimum on the chart. The price tests it with an impulsive movement on the lower time frame, and volume is confirmed in the form of a fair value gap. The position could look like this with a fairly good risk-to-reward ratio. We were lucky that the price made a pullback and didn't leave us behind. The next combination is also foundational to the algorithm, partially in the LTF part, but it has one very interesting feature, and a total of 3 variables. It is variable 1, volume confirmation, greater than variable 2, fractal point greater than variable 3, volume confirmation. To help you understand this combination's unique feature more quickly, recall the examples where fractal points were inside the zone of interest on a lower time frame and participated in obtaining volume confirmation. However, here we separate them into a distinct variable, after which volume is confirmed on an even lower time frame, forming the third variable. There are many variations of how this can look, but we will focus on only 3 of them. The first option is the formation of a fractal simultaneously with the zone of interest. In other words, it's the initial presence of a fractal point inside, which gives a small advantage if the zone itself is instantly tested afterwards. For example, this is a daily order block, and on the 4-hour chart inside it, there is a fractal maximum that can act as a liquidity injection. This also includes cases where the fractal point itself is the lower or upper boundary of the fair value gap. The second option is when the fractal point forms independently of the zone of interest. Most often it appears nearby or after some time, when the price could not reach the zone itself and reversed. Again, it's an order block, but in a bullish variant, and right in front of it there is a fractal low. And the third, most obvious option, is when the zone of interest is tested, the price gets a reaction, resulting in a fractal formation. A zone of interest formed after a liquidity raid. The next candle immediately tests it and gets a rejection. Moving to a lower time frame, we observe this minimum, which can be useful for us when the price approaches again. Regarding target calculation, the situation is a bit more complex here. While in previous combinations the take profit was on a time frame equivalent to the validated zone, here we are actually validating a fractal point. It would be logical to assume that the target should correspond to the fractal's time frame. However, since the fractal itself is inside a zone of interest, one time frame higher, the target will correspond to this higher time frame. The first example is an FVG on the daily chart, which we can interpret as variable number 1. Moving to the 4-hour chart, we observe 2 fractal lows that could potentially be variable number 2 if this zone gets tested. The price makes a rather aggressive pullback, and the last candle takes out both fractals. On the hourly chart, this volume confirmation appears as an order block, which tells us that the price delivery direction has changed, so a position can be opened directly from it. The price takes quite a while, but eventually reaches the target, which is on the daily time frame. The whole issue is that this position contains 2 significant FTA zones, which hindered quick execution. I will address this topic at the end, after which we will analyze all combinations. In this example, it's an order block zone, but there's also a fair value gap inside, and all of this is on the daily time frame. If we look at the 4-hour chart, there's a noticeable fractal high that can provide liquidity to the market, after which the price is more likely to reverse in the opposite direction. It's pretty obvious that this is what happens on the hourly chart. A liquidity raid occurs, after which a confirmation signal appears in the form of an order block and FVG. For example, if we want to increase the risk-to-reward ratio, entry can be made from the second element. Apparently, there was a release of economic events at the moment of delivery to the target, which is why we see a long candle shadow. If desired, this combination can be shortened as quickly as possible by simply getting volume confirmation on the same time frame as the fractal. On the 4-hour chart, this looks like a regular order block. As you can see, there are only 3 combinations that form the core of the strategy and are indispensable. In all cases, the minimum risk-to-reward ratio acceptable up to the nearest trouble area equals 1.5 for position entry. But what should we do if a combination has formed? Seemingly all criteria indicate our advantage, but the risk-reward ratio simply doesn't match. Or sometimes we're just not confident in our idea and want to find something that will strengthen it. This is where an element I called liquidity injection comes to help. Unlike the HTF part, where we only use fractals as a separate variable, In the LTF part, we can also use FVG, from which position entry can be made depending on the combination. This entire lower line has one main function of liquidity injection. As per tradition, let's look at how this can appear, starting with the order block. Technically, everything remains exactly the same, and nothing has changed. When LI is a fair value gap, the position entry order is placed at its beginning, with the stop loss behind the extremum of the order block. In other words, behind the invalidation level. If LI is a fractal point specifically inside the order block, then the entry logic remains unchanged. Buy order at the fractal level, stop loss behind the extremum. In the case of a rejection block, as I mentioned before, we don't consider FVG. Only fractal points remain, which most often form in the context of a test. The position entry order is placed at the level of these points, and the stop loss is placed behind the maximum or minimum of the rejection block. And the last final case is when volume confirmation is a fair value gap. What is the main difficulty here? When we talk about liquidity injection in the form of fractals, from which position entry can be made to reduce the stop loss length, we absolutely cannot use, firstly, those fractals that might form the FVG zone. This won't help us at all. Secondly, fractals that formed in the context of testing the zone itself often take away all the strength of the fair value gap and don't provide much reaction afterwards, so it's not the best option. In the end, the only way that remains is to look for fractal points that are present inside the FVG zone. This will be the best solution. However, there is another method that is used only in the context of entry from liquidity injection. This is searching for the same FVG zones, but one time frame lower. In the trading community, this is called refinement. If you find such refinement and the risk-to-reward ratio satisfies you, then you can open a position from it. As for position targets, nothing changes here, since liquidity injection is just an additional variable for reducing the stop-loss length. Accordingly, the target remains the same as with any combination from the HTF part. There is just one important note. If LI is the fourth variable, then the minimum risk-to-reward ratio should be 2.0. Let's analyze several examples. On the weekly time frame, there is a fair value gap, and on the lower, daily time frame, this zone is tested, forming another FVG and order block. The latter can be considered as volume confirmation for opening a long position. The risk-to-reward ratio to the nearest trouble area turns out to be unsatisfactory. In this situation, we move to the 4-hour time frame to search for liquidity injection. Thus, if the zone we are working with is an order block, the position can be opened from the 4-hour fractal low, which almost coincides with the daily FVG, setting the stop loss behind the extreme. An alternative option is opening a position directly from the FVG without an additional element. In the end, we achieved a risk-to-reward ratio of 1.82 to the target. Now I'll show another example where liquidity injection is used as an additional variable to increase the probability of position execution, and in some cases, to reduce the size of the stop loss. The target we had for the previous position transforms into our zone of interest, from which we expect a reaction and volume confirmation. Specifically, on the daily time frame, a rejection block forms after a liquidity raid. Theoretically, this zone could be used to enter a position down to the weekly fractal minimum, but let's say we missed the entry or other reasons prevented us from entering the position. However, at the same time, we see that after the test on the 4-hour time frame, a fractal maximum formed, which can potentially serve as liquidity injection, and the position opens from it. The stop loss is placed at the invalidation level of the entire idea, that is, beyond the rejection block extreme. The price makes 2 more deeper entries, accumulating more volume for selling, and then drops down. A very similar example, the price makes a liquidity raid on the weekly time frame and a descending daily rejection block forms as volume confirmation. After several days, when the price comes to test this zone, it doesn't reach it, and a fractal maximum also forms on the daily time frame, which can serve as our potential entry point. After a few more days, the price forms a weekly FVG, then returns and makes a raid, from which it suddenly receives aggressive selling volume that takes it to the trouble area. In both examples, the risk-to-reward ratio exceeds 7-1, which is very good. As you can see, the logic works, but you need to remember that these entry variants using rejection block are quite risky. So not everyone will be able to use them beneficially for themselves, but I've explained the main principle. To make it easier for us to move forward, look at this diagram. It is unified for the first two combinations from the HTF parts. Initially, it's as simple as possible. We have a zone of interest, then volume confirmation. The trouble area must equal the first variable. If the minimum risk-to-reward ratio to it is 1.5, then a position entry can be made. The green color means that the stop loss is placed at the invalidation level of the idea itself, that is, beyond the volume confirmation extreme. If the risk-to-reward ratio is unsatisfactory or doesn't meet the minimum requirements, then you need to find a third variable in the form of liquidity injection. Similarly, if the trouble area equals the first variable and the minimum risk-to-reward ratio is 1.5, a position entry can be made with a reduced stop-loss length. However, the stop-loss still remains behind the extreme of the second variable, which invalidates the idea. But at this stage, we can reach what we might call a splitting point. The first situation is when the risk-to-reward ratio still doesn't work for us. In this case, the only thing we can do is wait for the test of the third variable and get another volume confirmation in its context. This will be either an order block or a fair value gap. We don't use rejection block since it forms too frequently on smaller timeframes and can be misleading. Note that the color here is already orange. This indicates the stop-loss placement, where only the local idea will be invalidated, not the general or global one, which is determined by the first and second variables. Regarding the target, we have already discussed this logic. Essentially, the fourth variable validates the third, which in turn is inside the second. Therefore, in this case, our trouble area will be equal to the second one. If we get a minimum risk-to-reward ratio of 2.0 to it, then position entry can be made. In this example, the first variable on the 4-hour chart is a fractal low. After testing it, there is an aggressive reaction followed by the formation of an order block and fair value gap on the hourly chart. Regardless of the chosen entry zone, the stop-loss length turns out to be too large, and there is no clear target. Therefore, it makes sense to move to a lower time frame and check for liquidity injection. The only obvious option is a fractal point inside the FVG, from which the price might get a reaction. However, simply placing an order from this point won't significantly improve the situation. Therefore, the most reasonable solution is to wait for a raid, get additional volume confirmation, and only then enter the position. This is exactly what happens. A fair value gap forms on the 5-minute time frame, from which the position is opened. Stop loss is placed behind the local minimum. The target is set at the level of the second variable on the hourly chart. As a result, we get a risk-to-reward ratio of 2.8 in 2 hours. The second situation usually occurs when there is no liquidity injection. In this case, we can simply wait for the test and get another volume confirmation. Since here the third variable only validates the second one, the target or trouble area will equal variable number 2. As we can observe, the color is orange again, which means the stop-loss level that will be placed behind the extreme of the third variable will not invalidate the overall idea, but only the local one. However, position entry will again only be executed when the minimum risk-to-reward ratio exceeds 1.5. In this example, the zone of interest is again in the form of a 4-hour fractal low. After its raid, the price confirms volume on the hourly time frame. Even if we try to open a position from this FVG to the nearest opposite fractal with a stop-loss behind the movement extreme, the risk-to-reward ratio is practically 1-to-1, which is not interesting for us. Moving to 15 minutes, and there we find smaller FVGs, which we call refinement, but again the risk-reward does not exceed 1.5 in this case either. We are left with only one option that can help us monetize this idea, to get an FVG test and confirm volume. On the 15-minute time frame, this confirmation is again in the form of a fair value gap, from which we enter the position with a target at the nearest hourly fractal high. The price makes a test, then quickly reaches the take profit, which allowed us to achieve a risk-to-reward ratio of about 3.5. But if we had set the target at the level of the first variable, the risk-reward would have been 1-to-10. However, such a position would have been much riskier. Note that the stop-loss is placed at the invalidation level of the local idea, not the entire context. The last two combinations are very rare cases, but they can also exist. The first one stems from the fact that we again don't get an optimal risk-to-reward ratio, which forces us to look for another liquidity injection in the form of a fourth variable. The target doesn't change, it remains equal to the second variable, but the minimum risk-reward here is already 2.0. In other words, if we look at this same example, Here on the 5-minute time frame, we would want to see some kind of liquidity injection that would reduce the stop loss length. Here there was just a fractal that formed the FVG zone. The last combination, where we need to get another volume confirmation. The target equals the third variable and the minimum risk reward is 2.0. In reality, if you are forced to wait for one of these two options, it's best to ignore any potential entry because you likely won't get anything good, despite it being allowed in the strategy. In this example, the fourth variable was an order block and FVG, but they weren't tested at all, so as you can see, it's not worth focusing on this. This diagram refers to the third combination from the HTF part, which includes the second variable in the form of a fractal point. And if the trouble area is at a distance exceeding a risk-to-reward ratio of 1.5, then an entry can be made. If you didn't quite understand this, rewind back and review the segment where I explained it. The second option is when the risk-reward is not suitable, which may force us to look for another variable located in the fourth position to reduce the stop-loss length. The target will also be set at the level of the first variable. Let's look at such an example. On the daily time frame, there are two potential zones from which the price may give a reaction. After testing the order block level, we see a surge in buying volume. This fractal low automatically becomes variable number 2 if the price tests it. In the context of the hourly time frame, we see a raid and the formation of several order blocks, as well as 2 FVG zones. Here to the nearest trouble area on the daily time frame, we get 2.3 risk-reward ratio if entering simply from the lower order block. But let's say we can perceive the first trouble area in the form of this fractal high as a level that will slow down the price movement or completely reverse it. Therefore, we want to hedge to get a risk-to-profit ratio of 1.5 to the FTA itself. The only method that can be used here is to switch to 15 minutes and place a buy order from this FVG, which has the liquidity injection function. The price tests it and reverses, reaching the target. It should be noted that it simultaneously corresponds to the FVG from the hourly time frame from which a position could also have been opened. This isn't particularly significant, as my goal is to show examples to make the logic of actions clear. Also at this point, I want to make an important note. This method of reducing the stop-loss length should only be used when necessary, because if you try to do this every time, you will simply miss most positions, which will negatively affect your long-term profitability. In the end, the risk-reward to the trouble area is approximately 1 to 3, which is very good. The last example is when there is neither a desirable risk-reward to the nearest trouble area nor liquidity injection. Then the only way is to get another volume confirmation at the position of the fourth variable. Here's an example. The price rebalances FVG on the daily time frame. A fractal minimum is taken out on the 4-hour time frame, and volume is confirmed on the hourly time frame in the form of FVG. But the problem is that the nearest trouble area is very close, which prevents us from taking any action. Even liquidity injection on a lower time frame can't do anything here, so we wait for volume confirmation on the 15-minute time frame. Specifically, this type of order block forms, and from it to the trouble area in the form of equal high, we get 1.6 risk-reward, which works for us. The price makes a fairly deep test, and the position reaches its target. During the editing process, I noticed that when entry is made from the fourth variable, it's preferable to have a risk-to-reward ratio of 2 to 1, which we don't have here. But the logic still worked out. At this point, we have covered all the basic logic needed to understand how this strategy works and follows idea validation. It is applicable for swing trading, intraday trading, and even scalping if you learn to ignore the noise of smaller timeframes. Therefore, it's time to make a brief conclusion. Essentially, there are two formulas that repeat everywhere. The first one simply validates the zone of interest on a lower time frame using volume confirmation. The second formula validates the zone of interest through liquidity injection 2 timeframes lower. The only difference is that a first trouble area appears, which will always equal the liquidity injection timeframe. The FTA may or may not be present, but it still needs to be considered when opening a position. Accordingly, the trouble area logically equals the zone of interest. I want to emphasize that the trouble area and first trouble area don't necessarily pose a threat to our positions. In many examples I've shown, the price went much further and often didn't even react to these zones, which leads to the thought, this strategy in its simple application is similar to trading from zone to zone. This undoubtedly gives an advantage, since positions can be opened even in sideways movements when it's unclear what the market wants to do in the longer term. However, there are also disadvantages that need to be considered. The first and most important disadvantage is that after testing the zone of interest and its validation, the price immediately comes to FTA or even TA, which very negatively affects the probability of execution, because we can never know what opposite volume will enter from these zones. If we estimate, we can expect either a reaction with a small retracement or a complete reversal. Therefore, when possible, it's safer to close the position with at least 1.5 risk-reward at the first trouble area. But this is just a recommendation that can be ignored in several cases. First and most important is a clear understanding of the global context and its variables. Broadly speaking, this means understanding the trend, understanding medium and long-term price targets. This also includes determining dealing ranges and order flow. Everything that helps define the context. The second relates more to an error that traders themselves make. For example, there's an FVG zone on the 4-hour chart. The price tests it and confirms volume on the hourly time frame, from which the trader enters a position, but immediately gets stopped out. This happens because no top-down analysis was conducted, which would have shown that there was a fair value gap in the same location but on the daily time frame. And, logically, it should get confirmation on the 4-hour chart, because nothing prevents price from making deeper retracements in the context of a daily zone of interest. The same story applies to fractal points. When a fractal is on the monthly time frame, and a trader confirms volume on, say, the hourly time frame, then gets stopped out and doesn't understand why. It's important to consider not only the zones from which price should get a reaction, but also those that are forming in the moment. I've seen many times when people opened positions at the same time when variables were forming against them, but 1 or 2 time frames higher. Finally, we've reached the second decision-making principle, which doesn't involve idea validation. Let me remind you of the formula: analysis, idea, decision. The principle here is absolutely simple. For example, during analysis, we discovered a zone of interest on the daily time frame, and by all criteria, we believe it can reverse the price in the opposite direction after testing. We simply open a position from this zone provided that the minimum risk-reward to the opposite zone on the same time frame is 1.5, with the stop-loss necessarily placed behind the extreme, not somewhere else. Looking at the algorithm, this is simply marked as variable 1 volume confirmation. We can also add liquidity injection in the form of a fractal point 1 time frame lower, from which the position will be opened. Variable 1, volume confirmation, greater than variable 2, fractal point. Let's look at several examples. A bullish fair value gap formed on the weekly chart. Based on this, we have an idea that after raiding the fractal high, the price will make a retracement to this zone, from where the upward movement will continue. For example, the target is the next fractal high. The position can be opened slightly lower than the upper border of the FVG to achieve a risk-to-reward ratio of 1.5. The stop-loss is still placed behind the absolute minimum of this movement. The idea worked out perfectly, and the price even continued moving to the next fractal high. On such high time frames, risk can be set at 2 or 3% per position, which significantly multiplies the profit. In the second example, the main zone of interest, from which we expect the price to get a reaction, is this daily order block that rebalanced the FVG on the same time frame, making it high resistance. It is also located in the high resistance dealing ranges discount zone. This strengthens the idea. A position can be placed from it with a target at this fractal high. But we can do it differently. We switch to the 4-hour time frame and see a fractal minimum, in the context of which the price reversal will be more likely, so the order can be placed from here. As a result, the risk-to-reward ratio turns out to be 2.3, which is very good. The price makes a test and moves to the target, and even much further. I hope you understood the main concept, and I want to sincerely thank everyone who watched until this point. This means that you are truly interested in gaining knowledge and learning how to apply it in practice. Unfortunately, my style and format of video production doesn't allow me to frequently upload content on YouTube and share useful information with you in a timely manner. Many people still encounter problems and misunderstandings with this strategy, so I want to announce that we have launched a private Discord community where everything will happen much faster and with better quality. You can purchase access by following the link in the description. Let's do a brief overview so you understand what to expect. The first page is Start, where the community's goals and rules are described. If you decide to join, make sure to read everything. Next are the announcements and content pages, where the main information, market analysis, and so on will be published. Below are 3 chats where the main server communication will take place. And even further down is the most interesting part and, in my opinion, the main concept of this server, the information section. First and most important is the database, where we will accumulate and structure knowledge so that even a beginning trader can get everything they need to start trading systematically and progress with minimal effort. By the way, I've already made the first post dedicated to notes, ideas from which will be needed on the next page. This is Community Notes, where each community member can freely create their notes about anything that, in their opinion, can benefit the community and themselves. Essentially, this is a second knowledge base that will be created by you. After all, one mind is good, but when many minds unite, it's 1,000 times better. And lastly, this is the forum where you can start separate discussions on specific topics or ask specific questions. At the moment, everything looks approximately like this, but we plan to add much more new content in the future. I'll be waiting for everyone. Also, don't forget to subscribe to the Telegram channel. There's a free chat there where you can communicate with other people.